Welcome to Investor in the Family Radio, a podcast about learning to invest. My name is Brian Bain, and I'm your host. At Investor in the Family Radio, we believe that every dollar and minute we spend is an investment in something, and together we want to make the best investments that we can, so thank you so much for joining us. On today's show, we have Jesse Moore back. He was with us a few weeks ago talking about Tesla and a few of the topics, and then I invited him to join us again today to learn more about his personal approach to investing. And we talk about lots of things, but a few specific highlights are why he pulled all of his money from the markets and started diligently reading Warren Buffett and Benjamin Graham. He talks about what it means to invest in a story instead of just a stock. We discuss the current opportunity that he believes copper is offering to investors and why he thinks many commodities are poised to face a supply struggle in coming years, and how he handles the struggle of finding value in today's overpriced markets. All these topics and many more today with Jesse Moore. Remember, our goal is to help you learn to invest financially in all of life. You can always find more at investorinthefamily.com. And if you've been listening to the show for any period of time, you know that this Wednesday, September 7th, is the last day to register for free for the online investing conference. Why would you want to do that? Because next week, beginning September 12th, Brett Jensen is going to share his top 2 highest conviction investments. These are picks and research he normally only reveals to his premium services. These are investments that he personally owns, his 2 highest conviction investments right now. If you want this information, it's free to you if you sign up by September 7th, this Wednesday. Go to onlineinvestingconference.com. That's onlineinvestingconference.com. And if you miss the sign up by the 7th, it's going to cost you $100. So hopefully we'll look forward to seeing you there, and hope you enjoyed today's interview with Jesse Moore. Well, hey, Jesse, welcome back to the show.
Thanks for having me back, Brian.
Absolutely. Well, we had a really good time a few weeks ago talking about some recent content that you created and some articles on some really fun stuff like Tesla and even asteroid mining and crazy stuff like that. We'll be sure and link to that episode for anyone who missed it. But after that time together, I wanted to come back and spend more time connecting with you specifically instead of just your content. So today we're going to do that. We're going to learn more about you, your investing background, your philosophy, and your approach. And so we're looking forward to having you.
Yeah, for sure. Thanks for having me back. Yeah.
Well, do you mind starting out by telling us a little bit about what your investing philosophy is, or even if you have an overall philosophy that you use to approach your investments?
Yeah, it's an interesting kind of progression. I started investing when I was pretty young, and my experience was in oil and gas, and there was a lot of I had moved to Australia, and I was seeing an interesting, I guess it wasn't so much of investing into companies as investing based on people's opinions. And what I saw was that I could invest in multiple drilling companies that had free carried wells, and basically invest in 4 or 5 of them. One of them would strike and their share price would go up 500%. And in the worst case, their share price would go down 30 or 40%. And this worked for about a year or so, where I made some really good returns with not so much money. So didn't last as long, because that was right when I first started investing. And it kind of intrigued me. And that obviously fell off as the oil price fell off.
Well, even there, let me pause for a minute there. So you were, not in a negative way, but you were kind of an insider in the oil and gas space at that time. So you could see what's going on behind the scenes that the typical investor reading annual reports obviously doesn't see. So What were you seeing that led you to make those investments?
I was basically doing what we do in drilling. So what we do in drilling when we want to predict down a series of decisions that we can't see at the moment is we assign probabilities to each of them. So I basically looked at 5 companies, assigned a probability of their well being successful based on publicly available data. And then I would use that to come up with the best distribution of money into each of these companies that would basically give an outsized gain. It's kind of a knockoff of Kelly. I think it's called the Kelly criteria.
Okay.
I can't remember the exact theorem. I heard it later on, actually, after I was doing this. But it's basically probability weighted gambling in a way, but where the gambling's in your favor.
Yeah, but I guess so technically you weren't using any information that wasn't available to any other investor, except I guess you had a little more inside knowledge as far as how to use the probabilities. I guess that was your advantage.
Yeah, exactly. It wasn't rocket science by any stretch of the imagination. It was It was basically seeing a fear of the market going into the drilling phase,
Mm-hmm.
and an exuberance on the outset of it. So, a company would come out and say, we hit 30 meters net pay, and the share price would go up $250 million, which is absurd in a lot of ways without knowing, flow rates and porosities and anything else. And you could basically just do this over and over again when the oil price was $130, because everyone was assuming that the next well was going to be that $1 billion company maker.
Right. Well, what makes you think of investing in small biotech companies waiting for like FDA approval? You invest in several that have a good pipeline, and maybe they've made it through a couple of phases. And if one hits, it makes up for 4 bad investments.
Exactly. It's almost exactly the same, except different sort of odds system. Because if you invest in 5 oil wells being drilled, you're almost guaranteed a hit. So
interesting. Nice.
Yeah.
But now that obviously prices have fallen, that's not a very lucrative place to be, I guess.
Yeah, exactly. Yeah.
Okay, I interrupted you. Go ahead, please. Thanks.
Oh, no worries. So basically did that for about a year and a half until the oil price started crashing, got caught in a couple positions. And then I started searching for another way to obviously make money in the market, and made a bad foray into biotech, made a bad foray into a couple other industries, and started doing a similar thing into tech, and was basically investing in very high leverage positions where I could get in a small tech company. So there was basically a tech boom in Australia, where companies would backdoor list, which is basically where they would come into a company that was no longer operating, and they could list on the stock exchange and kind of avoid the rules that you would normally have listing. I don't know the exact science behind the backdoor listing, but anyways, you could a lot of these companies would come on with options, very highly leveraged to a share price escalating, and you could invest in, again, 4 or 5. And I was doing this scattergun sort of investing style for a while.
And so when you're doing that, like how much like fundamental research would you do, or is it all just, hey, invest in a bunch and hope one works?
This was more of not invest in a bunch and hope one works. It was what story would people buy the most? So this is interesting. We were talking last time about they're not selling revenue, they're selling a story.
Right.
This was really what we were doing. What I was doing was I was kind of guessing who would people get interested in, and these companies are listing with market caps, in $10 million range. So right. extremely market cap. Low market cap, super high leverage, not for the faint-hearted, as I learned later on. But it worked. It worked really well. So those worked really well, as there was that irrational exuberance, as the saying goes, in those parts of the Australian economy. So that all those died out eventually. So I had to basically look into a different sort of investing strategy, one that was obviously easier on the heart, a little less stressful. So I started getting into value investing. So I basically pulled all my money out of the market, and I started reading anything I could find from Warren Buffett, Benjamin Graham, and a bevy of other hedge fund managers. And so now I've been basically looking into value investing, and I've continue to invest in commodities. Specifically, I invest in copper, is one of my biggest bull bets, I guess. And I write about oil, and I have an intention to get back into oil. Obviously, anyone that follows what I write would know what I think on it. I just don't think that the market has kind of changed the attitude to what shale's changed in the game. But as of now, I'm basically looking for value. I see a lot of difficulty in investing nowadays, and I'm really trying to find a way to find my place in that, I guess, and find a place where I feel comfortable putting my money, which has been difficult over the last year, and that's kind of the focus of a lot of my writing over the last couple months as well.
So tell me roughly what time frame did the progression you just described take place over? By how many years?
Would have been about 6 years.
Okay, that's a pretty good time frame. Okay,
yeah.
So it sounds like I can't validate this necessarily, but it seems to me that you've made what I'm beginning to see as a fairly natural progression for a lot of investors in a positive way. I think a lot of us, especially early on, come into investing and you want to make money, and naturally the faster you can make it, the better. And it's easy to come in with expectations really high on the onset. And a lot of times that's what we can be sold on. And you talked about, the probability weighted investing in oil wells then, which did go really well for you, which is great. But then the biotech foray, which wasn't as great. You did some of the high leveraged positions in tech. They worked really well for you, but there are a couple of hits, a couple of misses. But in the midst of all that, obviously you realized, okay, these aren't really long-term game plans. Would you say that's accurate?
Almost exactly. Yeah.
Yeah. And then you came, so what made you at that point turn to value investing?
I think I wanted to find a way to invest in undervalued companies. And from my reading, from reading a lot of Benjamin Graham, Warren Buffett, and on, I really got enraptured by this idea of investing $1 and getting $1.30 of value.
Mm-hmm.
I think the problem came when I actually went out to find it. It's really, really difficult to find with price to earning ratios are as high as they've ever been, and interest rates can't go any lower. There's obviously issues, depending on who you talk to, major issues in the economy. And it's become really difficult. So I've sort of transitioned into value investing in the later stages, and I still hold most of my money in cash because I don't feel comfortable in the market.
Okay.
And whether that's me not knowing enough or not feeling comfortable, it's going to be an interesting couple of years. I think what I tell people is I'm waiting for the crash, and I hold money in commodities and only copper, to be honest, because it's a commodity I think is fundamentally in trouble for how much supply they're going to be able to bring online over the next 10, 15 years. Whether I'm too early on that call is yet to be said, but we'll find out.
Okay, so with the copper, you have a short position, it sounds like.
No, I'm long copper. Okay. I think that, and I think I might be a little early, but I've written a couple articles on my reasoning behind being long copper, and it's copper. When you look at the industry, when you look at where ore grades are going, when you look at costs, which have dropped obviously as copper prices have plummeted, but the commodity's in a long-term struggle for supply. Mm-hmm. And right now we're just seeing the ends of that supply and companies trying to ramp up production to meet costs. And that might be this year, might be next year, might be the year after. But in the long run, we don't have the copper mines to supply a growing middle class world, right?
Okay, yeah, I misunderstood what you said. I thought you. I heard you say there was oversupply coming, which confused me, but I misunderstood you. Okay, that makes a lot more sense. Yeah. Well, that could be a whole podcast in itself. I think about. Oh, yeah. I don't follow copper closely, but I do, follow commodity prices, generally speaking, at least to be aware of them. And from an outsider perspective, it definitely looks like copper and other related commodities. Just think, man, at these prices, if someone's patient, it's got to pay off in the long run, even 5-10 years. That's my outsider mindset. It sounds like that's kind of where you are as well.
Yeah, I'm not a risk taker.
You are a little bit based on how you got started investing.
Yeah, absolutely. How to describe it? Like, I don't look at like the copper company that I've invested in is extraordinarily high risk.
Okay,
there's an extremely high chance that they will go to zero in the next couple of years. But there's also an extremely high chance that they will be 10, 15, 20 times the value if copper does exit the bull market and go up to $3-4. Mm-hmm. So I see that as a risk weighted heavily in my favor, because I can lose 100%, but I could gain whether it's 1,000, 1,500%.
Mm-hmm.
Preferably in that type of situation, I'd like to have 4 or 5 companies like that.
Mm-hmm.
But if I'm right about copper, I don't need to find 4 or 5 today. I can find one today, and if that fails, I can find another and another, and eventually the payoff of the 3 or 4 failures will be made out by the one that succeeds. And it's almost another break off of what I was doing with tech and oil, but a bit more long term. This is a smaller portion of my portfolio. Obviously, this is say 10%, 15%, because the gains are so high and the losses are so huge. I'm not going to devote 100% of my portfolio to that. What I would like to do is start getting into dividend growth stocks, which is really, really difficult to do if I'm looking at it from a value investing perspective.
Yes.
And yields are 2%, and there's companies are overvalued from many, many different historical perspectives, right?
Yeah, well, actually, so I want to go back to something you said a while ago, because I was going to ask you about portfolio strategy a little bit. Now that you're talking about some of these higher risk investments and the way you're approaching those. So did you say that copper investment that you'd be willing to put as much as 10%? Is that in that position? Is that accurate?
Yeah, I think it's about 5-10%. Yeah.
Okay.
Yeah.
So I guess the mindset would be you could put 5 to 10% there. And if that theoretically goes to 0, you could do that, 3, 4, 5 times. And as long as one of them hits like you're hoping it will, it'll be worth it.
Yes. Yeah.
Okay. Yeah. That's one of the things I was going to ask about, because a lot of times there's the tension between, I want to have a fundamentally strong portfolio, and you see opportunities that are potentially high risk, high reward over here on the side that you feel like I don't want to pass up on these, but trying to figure out how to balance that all out can be a struggle, obviously.
Absolutely.
And one of the things I'm looking at doing is helping listeners to be able to come up with portfolio strategies. And it's one of the things I like to talk about in the podcast and other services we provide. And so it's interesting to hear that you're putting that big of a position. They're not critiquing it, but that's more than I would have expected, considering how much cash you said you're holding. But I guess if you get that much cash, then it helps balance out from a conservative perspective.
Yeah, it's something I think about a lot. I'm not concerned about my ability to earn money in the future. So
right.
I've set
that's significant.
Yeah, and I set a portion of my money aside, and I say I'm not going to touch this. I'll never lose this, and this is what I'm going to retire on in 30 years, whatever it ends up being. What I always talk about is reaching financial freedom and getting to that point where I don't need a job, but I can have one, and I can work in a place I want and do the things I want. And that's kind of my goal, rather than outright retirement. I don't want to retire when I'm 40 or 50 or whatever it ends up being. But right now I have enough money with the plans that I am making for me and my partner, that I'm comfortable with making an outweighted risk like that. So if I lose that 5%, that 10%, right now, say it's 5% and I want to double that position, I would still feel comfortable with that, as long as I was comfortable with the company.
Right.
I wouldn't want to put all my eggs in one basket, because there's so many risks that tack up on a copper mine, that any one of these can hit at this year, next year, and wipe out the value for a while. But I feel comfortable with that amount of money and losing it and having it not change my lifestyle. But on the upside, I feel like that can change my lifestyle. And I think that's a much more risky view than many people would have. And a view that's changed drastically over the last 5 years. Like, this is what I used to do with all of my money. I was young, and I was like, well, what's the worst that could happen? I used to be in university and make negative $5,000 a month. So it's nice to even have anything. So that's obviously changed over that time. And if you talk to me in a year or two, that'll probably be completely different again. So it's been a pretty smooth transition. Well, not smooth transition, a pretty quick transition over to more value investing. And another thing I'm struggling with is, whether I can beat the market in the long run.
Right.
Because when I look back at my strategies, they seem a lot like luck. And I think this is something that's hard to get past, is the personal bias and the confirmation bias and how much luck was involved. And it's an interesting discussion to have with yourself and with your friends. And it's a difficult answer, especially when you start thinking long term. And, this isn't, you're not playing, well, speaking from a couple of years ago, you're no longer playing games with some money and making and hitting all the time. When you start losing, it starts getting really hard, right?
Yeah. Well, first of all, I want to say the fact that you even had a thought out response, I think is awesome, because unfortunately, a lot of times when I can have these dialogues with people, and if I, ask a question like I did, there's not always a thought through response that's there, and so the fact that you've thought it through, because the position you're taking in your portfolio, in my opinion, I mean, if someone has a thought through approach and a plan, then go for it. I mean, obviously everyone needs to make your own decisions and stuff, but you know what you need, you know where you are, you know what you're doing. I mean, obviously learning, but you know why you have the position, you know how it fits into your portfolio, and you've weighed the chances. And that's great. I've plenty of respect for that. And I think what you said as far as, your portfolio approaches and strategies changing, evolving over time, and having the integrity to admit the fact that some of your success does seem a little bit like luck. Doesn't mean no critique there, but I appreciate your willingness to be able to even acknowledge that. Because like I said, it is hard. You don't have to invest very long to run into people that will say you can't beat the market. Anyone who does over time, it's luck. It's don't even try. All self-directed investors do poorly, all that kind of stuff. And so it's hard, especially when you're having the dialogue with yourself, to figure out how do you make sense of all that. And so I appreciate your thoughts there.
Yeah, it's a really interesting thing. You hear random walk theory and efficient market hypothesis, and there's always outliers, and that's what they're pushed out to be, is just outliers. And something that I've seen in my investing and what's worked, and the difficult part is that it doesn't work anymore. So right now I'm sort of looking for that investing style, because the tech boom ended and the oil boom ended, and that irrational exuberance that I used to invest on is gone. And what I've always kind of looked for is people that are undervaluing risk, people that are in a liquidity position where they need to exit, and it's getting more and more difficult to find that. On the upside, I took a couple chances at shorting stocks and missed by a month here or 2 months there,
right?
And you get completely wiped out, rather than because my only way of doing it in Australia was to short through options.
Okay.
And it's difficult when you think the whole market's overvalued, and there's always hidden risks when you go and try and short a stock. You might be right. You might find a company that is close to the market changing its idea on. But if you're not right and you're using options and you're not right at the right time, you're still wrong. So there's being right and still being wrong. There's being wrong, straight out wrong. And then there's being right and not even really making any money out of it. So when you add everything up, it can be really frustrating. And I think that's where a lot of people are now looking at the market and trying to find somewhere to put money. At least that's my feeling.
Right.
Obviously, people tend to view their own opinion as how others see it as well. But I think that's something that a lot of people are struggling with, and what I'm struggling with is where to put the money. And it's also frustrating to hold cash, because you get 1% or 1.5% in a government bond or in a savings account, whatever it may be. And you're completely unprotected from inflation. You're completely unprotected from rising interest rates. And it's a difficult position to be in. And
one of the things that that I enjoy about this show on my end is getting to hear from so many different people and getting to have these discussions, like people like yourself who are in the midst of it, wrestling with it, trying to figure things out, because I get to see a whole wide array of approaches. And I love that you're landing on value investing. I love that you're looking at dividend growth investing. But also, like you said, with dividend growth investing, it's hard because of all the things you just mentioned. People are looking for yield, and there is yield as a DGI investor, but the premium on some of those companies it makes it tough to buy into them. So that makes it frustrating, like you already mentioned. And then trying to find undervalued companies in the markets right now. I know they exist, and I think you're identifying some in the copper space. Obviously, come with some risks, but one of the things that I hear so much is the concern over holding money in cash. And you mentioned exactly the reasons that people are concerned with that. You're not getting any return. You're losing money to inflation, which is totally true. And I have those same tensions. But what I wonder if, and it's so hard because we always think in terms of like weeks and months, and we don't think in terms of years and decades enough. If we can hold the cash, if we can be sober-minded enough to recognize, you know what, markets are overvalued, and everyone around me seems to be, fighting and clawing their way into trying to find a good investment right now, and because they have to have their money invested. What if I just wait, like you said you're doing, like you've got a lot of your portfolio in cash, you're just waiting because eventually there's going to be some big pullback, and I'm not trying to be a soothsayer, but something's going to happen. Whether it's 20% or whether it's a full-on crash, I still feel like everyone's faking it regarding the economy, and something's going to happen with the market in the coming years. But I have no crystal ball, but I feel like I have common sense, and so that's what I'm relying on there. But that being the case, if you or I are willing to hold a chunk of our portfolio in cash and wait 2-3 years, something like that, for that market event to happen, the whole concern about losing money to inflation will have been meaningless because at that point you're paying 25 cents on the dollar, and you can just get to thrive on that recovery as it comes out, but that's somewhat, you have to have a decade type mindset to do that, and that's really hard.
And there's always somebody telling you this time is different, and
and it almost never is.
Yeah, exactly. And I'm that guy in oil right now. Like, I write about oil a lot, and I'm writing about that this time is different, and that companies need to be valued at $60 oil in the long run. And I get a lot of pushback from that.
I bet.
And that's what I'm on the economy, the cyclical economy, and a bear market coming in the stock market. Sometimes I feel like I'm on the other hand, I'm the guy saying it's going to happen again. It always happens. And people are telling me this time's different because of low interest rates can't go any lower. And people have nowhere else to put their money. So they might as well put it in the stock market. And it's an interesting side of the coin to be on in two different, look at the economy this way and look at a commodity this way. Be on this, both sides of the coin. So it's interesting.
I feel like it's a situation of how long do you want to ride the gamble? Because you're right, rates are low, there's QE, like the whole idea, well, where else can you put your money? All that out there, and I get that. Those are all valid comments and arguments. But at the end of the day, like all those things all exist because the economy is so unhealthy, and no one can look at the global economy and think, hey, things are getting better. Anyone that meaningfully looks at the global economy and says things are improving, I want to know what office you're running for, because you're not selling me on anything. I've got a friend that works at Trinity Industries, or it's one of the major U.S. rail car companies. And this is mid-August 2016. I'm recording this, and he just said they just finished their 4th round of layoffs.
Oh, wow.
Yeah. I mean, fortunately, he still has a job, and I'm thankful for that. But the thing is, if rail car shipping is struggling that badly, then, I mean, that means stuff's not moving in the U.S. economy. And that's a pretty significant indicator. That's just one of a million things you could point to. But, I mean, bottom line is I lean where you're leaning, in that those ideas of where's the money going to go, how are they going to invest it, I feel like that's all kind of cheap, short-sighted perspectives. And I think for a time, the market will keep riding that idea. And I think stuff will still rise probably for a little while on that. And for me, it's a matter of, well, am I willing to sacrifice some gains right now for the potential of not losing a lot later? And I don't know. I don't have a solid answer on that, obviously, but I definitely I continue to lean to the cautionary side as well.
Yeah, and I think to look at it from a different point of view, and this is how I look at it. If I hold all my money in the market today, I might be getting 1-2%, whatever the yield ends up being, and say the stock market continues to climb. I might make 7, 8, 10% over the next couple of years, but eventually, assuming that this time is not different, eventually I'm going to be able to pick up those same companies for half the price.
Right.
And my money's going to be in those companies when they drop.
Right.
So if you hold your money today, and I wrote an article about this a long, long time ago, and what it basically looked at is if you exited at any point in 2 years leading into a market crash and invested at any point in the year after, you would have made 400% or 500% gains over that period. And it's not that clear cut.
Sure.
But that's another way of looking at it. If you go in with 100% of your money in cash and a market crashes and you start buying companies at the bottom, you're going to make whatever you would lost in foregone returns and then some.
Right.
And then
exactly.
some more. And I think that's a different way of looking at it. Rather than saying I'm just losing now and saying I'm going to gain in the long run.
Yeah, I think it just echoes why it's so important to have some kind of a plan or strategy, because everything that I just mentioned and you just mentioned, someone could come in and point a hole in it or poke a hole in it. Well, what about this or what about that? And they'd have good points probably, because how long do you want to wait for a crash to happen? And I don't think that's necessarily a way for neither one of us are advocating that.
Yeah.
But but there's so many different ways you could approach it, and I think the important thing is just have some kind of plan. Whether that plan is I'm 50% invested and I'm 50% in cash and I'm waiting, or I'm 30% in cash and waiting, and 50% of what is invested is in, good value plays. 20% is in some maybe a little more high risk reward, like some things you've mentioned that, if one of those high risk reward investments pays off, then you've made up for the fact that you've got 30% of your portfolio in cash, because any potential lost yield you would have had there, you just made up for it with a big home run on a small biotech or other technology or commodity or option play, like you mentioned. And the thing is, you said it already, it's just hard.
Yeah.
No one knows what's going to happen. And so we have to figure out how cautionary do we want to be with our portfolios, depending on our financial situation, depending on our future earnings potential, depending on our life stage. And one of the things I struggle with is eventually we start saying a lot of the things that all of the quote unquote boring investment houses or places have said from the very beginning, like diversify, be conservative. And you're like, well, that's boring. And you're like, well, maybe there's a reason for that. But I do believe there is some kind of a middle ground there. I think most self-directed investors want to beat the market, obviously, but they internally feel like, hey, I can do this. I can find this company. I can, put in the extra effort to beat this really boring mutual fund. And I believe that is possible, but my fear is that most self-directed investors have no plan and no means to filter their emotions. And I think because of that we end up self-sabotaging ourselves over and over and over again. And that's why I think conversations, hopefully like the one you and I are having, and other things we do here at Investor in the Family, will help all of us to overcome both those obstacles.
Yeah, for sure.
Yeah. Well, Jesse, as always, man, this has been a great time. And I, just like last time, I'm thinking, man, I've got about 10 more questions I want to ask you, but we're toward the end of the show, which, that just means we'll have to do it again if you're open to it. We'll get back together and we'll track on how things are going. And I'd love to learn more about how your investing philosophy continues to evolve. But man, thanks so much for your time. And I look forward to talking to you again soon.
Sounds good, Brian.
Well, I hope you enjoyed today's interview with Jesse Moore. Remember, you can get full show notes with links and other details at investorinthefamily.com. And if you want to hear Brett Jensen's top 2 highest conviction premium service access only picks, Access is free at the online investing conference if you sign up by September 7th, Wednesday of this week. Go to onlineinvestingconference.com. That's onlineinvestingconference.com. And you can sign up for free there. Price jumps to $99 after the 7th. And information goes live on September 12th. That's next Monday. If you have any questions, visit us at investorandfamily.com. You can chat or email us. We'll look forward to answering any questions that you have. This is Brian, and thanks for joining the family. The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.